What if I told you that right now there are companies literally paying you just for owning a piece of them? No job, no side hustle, no grinding, just money showing up in your account every quarter like clockwork. That's dividend investing, and in 2026, it's more accessible than ever. I'm talking about building a portfolio that could eventually pay you $500, $1,000, even $2,000 a month without you lifting a finger after the initial setup. But here's the thing. Most beginners get this completely wrong. They chase the highest yield they can find, get burned, and swear off dividend investing forever. Today, I'm going to show you exactly how to avoid that trap and build a real dividend portfolio the smart way, even if you're starting with just $100. Hey, Wealth Builders, welcome back to The Wealth Wise Way, the channel where we break down building real wealth without the Wall Street jargon or the fluff. If you're new here, we make videos every week helping young professionals like you actually understand investing so you can stop feeling behind and start building serious money. Today's topic is dividend stocks for beginners. And by the end of this video, you'll know exactly what dividend investing is, how to spot the good stocks from the traps, how much money you actually need to start, and the exact platform I recommend for buying your first shares. Let's get into it. What are dividend stocks really? Let's start with the basics, because I want everyone watching to be on the same page. A dividend stock is simply a share of a company that pays out a portion of its profits directly to shareholders, usually every quarter. Think of it like this. When you own stock in a company, you technically own a tiny piece of that business. Some companies, especially large, stable, profitable ones, choose to share their profits with owners like you instead of reinvesting every single dollar back into the business. That payment is called a dividend. So let's say a company pays a dividend of $1 per share every year, and you own 100 shares. That's $100 a year, or about $25 every quarter, just for holding those shares. Now, companies aren't required to pay dividends, and plenty of great companies like Amazon and Tesla historically don't. But the ones that do tend to be more established, cash flow positive businesses like Coca-Cola, Johnson & Johnson, or Procter & Gamble. These are companies that have been around for decades and have a track record of consistently rewarding shareholders. This is really the foundation you need to understand before we go any further. The metric. Everyone gets wrong. Dividend yield. Okay, this is where most beginners mess up, so pay close attention. Dividend yield is the percentage you get when you divide the annual dividend payment by the current stock price. So if a stock costs $100 and pays $4 a year in dividends, that's a 4% yield. Sounds simple, right? Here's the trap. Beginners see a stock with a 12% or 15% yield and think, jackpot. But in reality, an extremely high yield is often a red flag, not a green light. It usually means the stock price has crashed because the company is in trouble, and that dividend is at serious risk of being cut. This is called a dividend yield trap, and it has burned countless new investors. What you actually want is a sustainable yield, typically somewhere between 2% and 6%, from a company with strong, consistent earnings. I'd rather own a boring company paying 3% that grows that dividend every single year than chase a flashy 14% yield that gets slashed to 0 6 months later. Sustainability and reliability beat a big number on a screen every single time. Remember that. How to actually evaluate a dividend stock. So how do you separate the real deal from the trap? There are a few key things I look at every single time. First, the payout ratio. This tells you what percentage of the company's earnings are going toward dividends. If a company is paying out 90% or more of its profits as dividends, there's very little cushion if earnings dip, and that's a warning sign. I like to see payout ratios under 60%. Second, look at dividend growth history. Companies that have increased their dividend for 10, 20, even 50-plus consecutive years are called dividend aristocrats and dividend kings. These are businesses that have proven they can grow shareholder payouts through recessions, pandemics, and market crashes. That consistency tells you everything about how well managed the company is. Third, check the overall financial health, revenue growth, debt levels, and free cash flow. A company drowning in debt with declining sales is not going to sustain its dividend no matter how good it looks today. Combine these three factors and you'll avoid 90% of the mistakes beginners make with dividend investing. Building your first dividend portfolio. Now let's talk strategy, because knowing what to look for is only half the battle. When you're just starting out, you don't need 30 different stocks. In fact, I'd recommend starting with either individual blue-chip dividend payers or dividend-focused ETFs, which are baskets of dozens of dividend stocks bundled into one investment. ETFs like Schwab's SCHD or Vanguard's VYM are hugely popular for beginners because they instantly diversify you across dozens of quality companies for one price. This is honestly how I'd recommend most beginners start. It removes the guesswork of picking individual winners. As you get more comfortable, you can start adding individual stocks from different sectors. Maybe a consumer staple like PepsiCo, a healthcare name like AbbVie, and a financial company like JP Morgan. Diversifying across sectors protects you if one industry has a rough year. And here's a huge tip. Turn on dividend reinvestment, often called DRIP. This automatically uses your dividend payments to buy more shares, which compounds your growth dramatically over time without you having to do anything manually. How much do you need to start? Here's the good news. You do not need thousands of dollars to start dividend investing in 2026. This is where a platform like Robinhood becomes really powerful for beginners. Robinhood lets you buy fractional shares, meaning you can invest as little as $5 or $10 into expensive stocks or ETFs, instead of needing to buy a full share that might cost hundreds of dollars. So if you've only got $50 or $100 a month to invest right now, that's completely fine. You can start building your dividend portfolio today rather than waiting until you have thousands saved up. The commission-free trading also means every dollar you invest goes toward buying shares, not eaten up by fees. I'll drop my link to Robinhood down in the description below if you want to check it out and get your account set up in just a few minutes. The key is consistency. Investing $100 a month into quality dividend payers over the next 10 years will build a portfolio that most people only dream about, simply because you started early and stayed consistent. All right, let's quickly recap what we covered today. Dividend stocks pay you a portion of company profits just for owning shares. Watch out for yield traps. A sustainable 2 to 6% yield beats a flashy 15% every time. Check the payout ratio, dividend growth history, and overall financial health before buying anything. Start with ETFs like SCHD if you want instant diversification, and use fractional shares on platforms like Robinhood to start with whatever amount you've got, even if it's just $50. If this video helped you understand dividend investing, do me a favor and smash that subscribe button. We're dropping new wealth-building videos every single week, and trust me, you don't want to miss what's coming next. I've got a card popping up right now with a video on the best dividend ETFs for 2026. You should watch next. Until next time, keep building.